In the fourth quarter of 2025, the national aggregate home price decreased 1.5% year over year. That according to a new report by Royal LePage, highlighting Canada's quarterly housing market trends. Let's get more on this from Philip Soper, CEO of Royal LePage. Philip, thanks as always for joining us.
My pleasure.
What are your thoughts on that number, the 1.5% decrease? Is it, are we hitting bottom, or where does it look like we're going?
You know, we've been treading water for some time now. And of course, the big story behind that aggregate national number is that some parts of the country with moderate home prices are actually showing some rather normal, healthy appreciation. And our two big metropolises continue to slide. So there is what, I think the last time we spoke, I mentioned this concept of compression in prices.
And where are we seeing some of the increases? Where are people moving to?
The biggest change in home prices to the positive continues to be in Quebec, and Quebec City in particular. Large public works projects there, a very, very tight housing supply. But we're also seeing robust markets as far away as Newfoundland, St. John's, Atlantic Canada is doing well, the prairies are fine. Even in smaller cities in Ontario and British Columbia, but Greater Vancouver, Greater Toronto continue to have soft markets, definitely a buyer's market in those regions, whereas the rest of the country, I'd put it in balanced market territory.
And do we know what's driving that? I'm just looking at that Quebec number. The year-over-year aggregate price increase, 13.2%. Do we know, is it people moving out of those two big cities, or is there money in those smaller markets?
Yeah, you know, Quebec, for example, and we could use smaller cities in Ontario as a parallel. You've got the metropolis of Montreal. Home prices are much larger greater than they are in Quebec City. It's only an hour and a half, depending where you are in Montreal and where you're moving to in Quebec. It's a short change in lifestyle for more affordable housing, and the employment situation there is very strong. But we could paint that picture across the country. What we saw start in the pandemic, when people woke up to the fact that if you lived in Toronto, you were paying 3 times as much for a home as, say, living in Calgary. The invisible hand of the market is working its magic, and after a few years of just slightly sliding prices in Toronto and rising prices in these other cities, like Calgary, for example, what was 3-to-1 is now 2-to-1. So it will impact interprovincial migration patterns, and we'll see less people leaving our two biggest cities for other parts of the country.
And is that the back to work that we're seeing with a lot of places, especially government-rich cities like Ottawa, Toronto, and bank cities like Toronto, Montreal?
Yeah, you know what? Back to work is definitely supporting segments like the beleaguered condominium segment. You know, we could use an easing of the restrictions on immigration, foreign students, that sort of thing, to boost our condominium market in big cities. But failing that, we are seeing back to work, having people look at living in city cores where they were quite comfortable with, coming in for a couple of days a week with a 2-hour drive, but not when it gets to 3 days a week or 4 days a week.
Mm-hmm. And what are we looking for as we head into spring? Is there a pent-up demand almost that people eventually are going to have to move?
Absolutely. The trade concerns, the geopolitical tensions, which have hammered consumer confidence. It's not so much that they're easing, as you know, but it is that people are adjusting to it. They're not waiting for perfect or calm on the world stage. They're seeing progress being made from a Canadian perspective, and they're getting on with it. So the spring market will be our busiest market, as it is every year. We're not expecting a ricochet or a roller coaster scream to the top of the curve during the spring market, but there will be pickup, and we are anticipating for 2026 that by the end of the year, prices will be up 1% over the year before. So essentially flat, but positive flat.
And what kind of an impact? I mean, are we seeing rent prices dropping? Are people deciding that they just want to stay maybe in a rental rather than look at buying and take on the responsibilities of buying? Is that having any kind of an impact?
Absolutely. Rents, they're very attractive in big cities right now, not in Quebec City or St. John's. So if you've got a tight for sale housing market, that usually translates into a tight rental market. But they're very favorable in places like Toronto, Vancouver, and that is attracting more buyers to the segment. It's challenging for small investors, though, to get into the market right now, and they are the ones that provide a lot of the rental stock in Canada. People who own 1, 2, 3 condominiums as a form of retirement savings, like an RSP, and they're challenged because they don't have the volume of people they did before the sharp curtailment of newcomers.
Okay, we're going to have to wrap it up there, but Philip, always a pleasure talking with you, sir.
My pleasure.
Philip Soper is CEO of Royal LePage.